Have you ever watched the market dip and felt that knot in your stomach, wondering if you should just sell everything and run? This week gave us one of those moments. On Wednesday, the stock market pulled back hard, red everywhere. But today, it bounced right back. And instead of panicking during the red, I made a series of moves that turned volatility into opportunity. In this video, I'll show you exactly how I executed a few option trades, why I closed out several sold puts, opened new ones right before earnings, and walked away with hundreds of dollars in realized gains. Not unrealized stock gains, real cash. Let's rewind to Tuesday. Tuesday morning, the mood was cautious, the fear index rising. By Wednesday, the market dipped even more. Headlines blamed everything: interest rates, inflation concerns, geopolitical uncertainty. But experienced investors know sometimes the market just needs to breathe. What matters is not the pullback, but what you do during it. While most people were scrolling and panic selling, I was doing the opposite. I began closing out a few of my sold put options, trades that were already sitting at 80 to 90% profit. Closing early is important. When you sell a put option, you take on the obligation to buy 100 shares of that stock at the strike price if it falls below that price before expiration. That means your brokerage locks up a large amount of your money as collateral. For example, I had sold a Tesla put with a $375 strike price. That means I needed $37,500 in cash ready, because if Tesla dropped below $375, I would be required to buy 100 shares. Selling puts is profitable, but also requires a lot of capital. By closing those puts at 80 to 90% profit, I released that cash early and could reuse the same money for new opportunities. With that freed up capital, I looked for the next setup. The best candidate was Tesla, just hours before their earnings report on Wednesday. I sold a new Tesla put option with a $385 strike price expiring at the end of October and collected $344 in premium. Why sell a put right before earnings when volatility is high? Because I did my research. Historically, Tesla moves around 7 to 9% after earnings, with the stock trading around $430 at the time. Even a full 9% drop would only bring it close to $390. So selling a put at $385 was a calculated risk. My thinking was simple. If Tesla stays above $385, I keep all $344. If it dips below, I still have about a week for the stock to recover before expiration. Worst case, I get assigned 100 shares at $385. I would not mind owning Tesla long term, because it could grow 5 times or even 8 times over the next few years. Or I could roll the option to a later date with a lower strike price to avoid being assigned. So what happened? After earnings, Tesla dropped about 4% after hours, but the next day it bounced back. That new sold put was already showing over $260 in profit in less than 24 hours. Tesla wasn't the only move I made. I closed my Palantir sold put for profit, then sold a new one with a $162.50 strike price expiring November 7th and collected $474 in premium. I also sold an AMD put option with a $205 strike price, also expiring November 7th, and collected $455 in premium. A few other put options and a long LEAP call option were also part of my trades. Each of these trades used the same capital over and over again, like renting out money instead of letting it sit unused. So what is the real takeaway from all of this? When the market pulls back for no strong reason or because of a scary headline, don't panic sell. Panic never builds wealth. Instead, manage your cash. Keep your buying power available. Be ready to take advantage of fear. If I didn't trade at all on red days, my portfolio would still recover when the market recovers. But by being proactive and selling put options, I'm not just waiting for recovery, I'm accelerating it. And unlike stock price increases, option premiums are realized income, cash in hand. I can reinvest that money into stocks like Tesla, Nvidia, AMD, Palantir, or sell more options to keep growing. So the next time the market dips, ask yourself, am I going to panic, or am I going to position myself for the bounce? This strategy isn't magic, it's discipline, it's understanding risk, it's using fear as opportunity instead of letting it control you. If you want to grow your portfolio using strategies like these, selling put options, managing risk, and making your money work more than once, then subscribe to the channel, hit the like button, and turn on notifications so you don't miss future trades. Why pay hundreds of dollars for a private group or subscription when you can learn it here for free? This is not financial advice. I'm simply sharing what I do with my own money. The market will always move up and down. That's just how it works. But whether you panic or profit is your decision. Thanks for watching, and I'll see you in the next one.